Regardless of whether your goal is to have $1 million portfolio by the end of next year or by the end of your life, it ultimately comes down to the same three factors, which are TRM, time, return, money. How much time do you have for money to compound and grow? Return is how fast can you grow and double your money? And money is how much money can you invest? If you have $950,000 to start with, you already have a lot of money, which means you can get a very low return and still hit the $1 million portfolio in a short period of time. If you don't have $950,000 to start investing, that's okay. You can also focus here on improving your returns. The better your returns, the faster you can double your money, the faster you can get to the $1 million portfolio. You might have heard people say, if you start with 1 penny and you double that penny every single day, so you start with 1 penny today, 2 pennies tomorrow, 4 pennies the next day, after 30 days, you will have more than $10 million, which is the power of your return. But even if you are a horrible investor, you don't know how to get good returns, you don't have a ton of money to start, well, you can make up for that by having more time. Letting your money compound for more time, that way you can hit that $1 million portfolio. See, the way you build wealth is a combination of these three things, and let's break down now how this actually works. The stock market, more specifically the S&P 500, has grown by just over 10% a year on average over the last 100 years, which means the average market return is about 10% a year. So now let's have some fun. Let's play with some numbers, and then I'll show you how you can actually do this with your own portfolio. For the sake of this video, let's assume that you're not outperforming the market, you're just getting the returns of the market, which is about 10% a year, and let's assume that you can only invest $100 a month. If you can invest $100 a month, you get a 10% annual return on your money. You do this every single month. It's going to take you about 46 years to retire a millionaire. Now you might say, well, Jaspreet, I don't want to wait 46 years to become a millionaire. Well, you can work on this or you can work on this. You can work to get better returns, increasing your financial education, learning how to invest better, taking on some more risk, or you can work to invest some more money. Maybe you work to get a raise or a career change or get your finances in order, and now you can invest $500 a month. If you can invest $500 a month, you get the same 10% return. Now it's not going to take you 46 years to hit that $1 million investment portfolio. Now you will do it in about 30 years. If that's still too long, let's get a little bit more aggressive. Let's assume that you can invest $1,000 a month. If you can invest $1,000 a month, you get the same 10% return. Well, now it's going to take you 23 years to become a millionaire. And if you say, well, Jaspreet, that's still too long, well, now you want to start also working on these returns. How can you improve your returns? So let's talk about now how you can actually invest your money and different ways you can get these returns. That way you can actually put your money to work. Now I want to remind you that if you are an investor, number one, investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. And number two, if you are an investor, my team at Briefs Media publishes a free daily newsletter called Market Briefs, where every day we break down what's happening in things like the economy, the housing market, the stock market, the crypto market, and the global economy into a fun, witty, and easy to read newsletter. We have hundreds of thousands of investors that read market briefs every morning. So if you have not joined yet, I get the link for you to join for free down in the description below. When most people think about investing their money in the stock market, they're thinking, how do I find the next Tesla? How do I find the next Amazon? How do I find the next Apple? You're trying to find this next hot stock. But the problem with this is that hot stock could go bankrupt. So if you invest your money into Tesla, into Amazon, into Microsoft, into Apple, whatever it is, and you do this month after month, year after year after year, and you don't know what you're doing, you don't know how to keep up with the company, and that company ends up running themselves into the ground and they go bankrupt, you lose everything. You can see why that's a problem. Now, it is more risk, more potential return, because if Tesla were to take over the world, you're going to make a lot of money. If Amazon takes over the world and you're investing in it, you can make a lot of money. If they go bankrupt, you lose everything. Higher risk, higher potential return. Earlier in this video, I talked about the S&P 500, how that's averaged a little bit over 10% a year. And the way that works is the S&P 500 is a group of the 500 largest companies in the stock market. So now, instead of just investing in one company like Tesla, you're investing in a basket of companies, which owns Tesla. It might own Amazon. It might own Apple. It might own McDonald's. It'll own this basket of companies, the 500 largest companies in the stock market. And the interesting thing about this is if one company were to start doing bad and they're no longer one of the 500 largest companies in the stock market, the fund would kick them out and replace them with a new company. For example, you might remember Sears. Sears was one of the largest companies in the world. They were a part of the S&P 500. But then when Sears started to struggle, they were kicked out of the S&P 500. So if you were investing in the S&P 500, you would have owned some Sears. But then as Sears started to go down, maybe your ownership of Sears would start going down as well, and then they would get kicked out of the S&P 500 and replaced by somebody else. So when you invest into these types of funds, you're lowering some of your risk, but also lowering some of your returns. Now you might be wondering, well, Jaspreet, how do I actually invest into something like the S&P 500? Now again, I'm not telling you what to invest in, I'm just giving you examples to help spark that investment part of your brain. But the S&P 500 is a basket, and you can invest in this basket by doing two things. Either you can go out and invest in all 500 of these companies individually, which is a lot of work, a lot of time, and now you still have to manage that portfolio. Or you can invest into a fund that gives you exposure to this S&P 500 fund. Here's a few examples of 3 different ETFs that give you exposure to the S&P 500. SPY, VOO, I'm personally invested in VOO, and IVV. These are 3 different funds created by 3 different investment institutions that all give you exposure to the S&P 500. Now, if you invest into either one of these, you're getting exposure to this group of the 500 largest companies in the stock market. When you do that, you don't have to worry about managing your portfolio per se, because the algorithm in each one of these funds is managing this portfolio. Now you might say, well, what's the difference? And the difference is, number 1, it's created by different investment institutions. Number 2, they might have different slight expense ratios, meaning fees, so you can compare the different fees on each one of these. And number 3, they might value the companies in each fund a little bit differently. For example, all 3 of these might be investing into Tesla, Amazon, and Apple, but they might value Amazon or Tesla or Apple a little bit differently in their portfolio. So these are things that you can compare as you're making your investment decision. Again, I can't tell you what to invest in because I'm just a random guy on YouTube. My goal is to start thinking like an investor. Because for the average person who's investing their money, they're playing the game of trying to find the next hot stock without knowing how to actually analyze the stock, without knowing how to listen to an earnings call, without knowing how to read a financial statement. If you're doing all of that, well, now you're essentially just gambling because you're just hoping that the stock that you buy is going to go up. And then if you don't have the psychology to actually manage your investment, well, now you're really running a risk because the reality is markets go up and markets go down. Now, here's the thing. You don't have to go out and invest in the S&P 500. There are a lot of ways to invest your money into the broad-based economy. For example, if you just wanted to invest your money into the United States stock market, there is an ETF called VTI. This gives you exposure to the total stock market. Is again an ETF created by a company called Vanguard. This gives you exposure to the total stock market. There are ETFs that give you exposure to the Dow Jones. There are ETFs that give you exposure to the NASDAQ. These are all broad-based ETFs that give you broad exposure to the United States economy. So now what you're doing is, instead of trying to find the individual company, you're just investing in the American economy, hoping that it's going to continue to grow in the future. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.